This residential apartment REIT has a current dividend yield of 4.6%, which hasn't been this high since the 2020 market crash. Based on the 5-year average dividend yield of 3.2%, this is a 43% discount. The dividend yield looks amazing, but are the fundamentals intact? First off, the stock we're looking at is Mid-America Apartment Communities, which owns residential apartments across the U.S., which we see here with a map of their properties. This is the first component I like to look at when investing in REITs, which is how well diversified they are by geographic distribution. MAA checks this box for me as they operate in 16 states across the U.S., although they predominantly operate in the southeastern U.S. Next, I like to see if the underlying number of apartment units are increasing over time. If we go to their annual report, we can see that in December of 2018, they had 101,000 total units. And as of their most recent quarterly report, they still have 101,000 units. This is a negative in my mind, as I like to see the number of rentable units growing over time. The next REIT foundation I like to check out is occupancy rates, since we want their apartments to be occupied and producing rent from tenants. MAA satisfies this requirement, having a solid current occupancy rate average of 95%. The last box I like to check is that rents are increasing over time. As of 2018, their annual rental revenues were $1.57 billion, and as of their most recent annual report, they are at $2.0 billion, a compound annual growth rate of 5%. So they've been able to increase their rent collections each year by 5% on average without having to develop or acquire new communities. Now that we've seen the underlying business attributes, we can look at the bottom line equivalent for REITs, which is adjusted funds from operation, or AFFO. Here we see AFFO graphed with this orange line and green shading over 10 years, plus one forecasted year. Their AFFO has been outstandingly consistent, having a maximum drawdown of only 3% between 2019 and 2020, and the CAGR over this period has been a respectable 6%. From a valuation perspective, it's trading at a significant discount, with a current price to AFFO of 15, while its 10-year average price to AFFO is 19, which is graphed with this blue line. And what's great about the software I'm using is we can see exactly how price has related to AFFO, depicted with the black price line, and we can visualize the degree of discount by how far below price is compared to the blue line. If you're interested in using this software and want a 25% discount off your first payment, I have an affiliate link in the description and pinned comment below, along with a promo code. Also on this graph, we have the dividend shown with this white line, which has grown by a CAGR of 6.7%. We can also see that the payout ratio has hovered around 65%, which is low for a REIT. If we scale back our time, we can see that since 2007, they have either kept their dividend constant or increased their dividend without fail, even through the real estate crash around 2008. I think this is one of the major benefits of owning this stock, which is that housing is essential and a robust industry. Furthermore, with increasing inflation, rent rates, which are one of the measured components of inflation, will continue to increase. But why is this stock trading at a relative low? It's because REITs are an investment class that typically carry a lot of debt, and interest rates are currently high, which is pushing down the price of the REIT market as a whole, which we can see here through the largest real estate ETF, VNQ, which has had a price return of less than 1% over 5 years. MAA currently has total liabilities of $4.4 billion and almost no cash. If we compare their total liabilities to their AFFO, they have an income to liability ratio of only 4.5 times annual AFFO, which is substantially lower than their peers according to their annual report when using EBITDA instead of AFFO. So fundamentally, MAA looks to be at a favorable buying point based on their degree of discount from a price to AFFO perspective and from a historic dividend yield perspective, all while having an extremely stable business foundation. But let's see if the stock looks as juicy from a technical perspective. Here we see MAA over 5 years, and the first indicator I like to look at is the standard deviation channel, shown with these 3 yellow channel lines. This tool shows us how far price is from the average, depicted with the center yellow line. Currently, the price is 38% below average, which is almost identical to how cheap the stock was in the 2020 crash, and we can see how price continued to rise from there. The next technical tool I utilize is standard support and resistance lines. Price just broke through a recent support level around $127 and is coming into a recent low support level around $115 if it continues downward. Lastly, we have the relative strength index graphed at the bottom of the chart, which indicates a favorable buying opportunity as the white line is nearing the bottom of the channel. So from a technical perspective, MAA checks all the boxes of buying at a low risk point, considering the standard deviation channel, support and resistance, and the RSI. If you want to see a stock analysis video of a company that looks to be at the exact opposite point of MAA, check out this video. Thank you for watching.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.